right, I was on mute. Hey, good morning, good afternoon. Can you guys hear me? Okay, cool. AMD. No, I did not have AMD for today. I didn't follow up on AMD, but because I don't own AMD, so I didn't really got into the details because I'm still a little behind on the stocks that I own. But I can take a note to maybe look at AMD for next week. Um, I know that I think the stock didn't perform well after the earnings, so there's something that gotta give on AMD. Anyone from California? I think a lot of folks here are from California. Catherine, anything specific? Even I am in California as well. All right, so let's see. I guess some other folks are yet to join, so let's give a few minutes. Meanwhile, I have something to share. I think I actually fixed the internet issues. So last week we had a lot of internet issues, and then on the weekend I was traveling. Monday when I came back, and I still start to have the internet issues. Works for 30 minutes, and then the connection will drop off. Called up Comcast again. Xfinity wasn't really helpful, and then Tuesday I decided I need to fix it, and started doing the whole troubleshooting, right? Whether it's a issue in the cable, it's a issue in the modem, it's a issue in the router, and eventually I think I figured it out. It's a issue in my router. I had to basically do a firmware update. And since after that, at least I haven't had any issues. At least I've not noticed. My kids haven't screamed at me. But if you feel that I'm getting dropped off or it's not, the connection is like breaking, do let me know. I hope that we'll not see issues today. So looks like maybe I was able to get it fixed. Cool. Happy Deepavali to you as well. So yeah. What else? So that's one update. So what do we have on agenda today? What I want for at least from my side, it's the first time we are meeting after the end of the month, right? So October just finished. So I'll give you a peek on how my portfolio is, what do I own, and I also want to give you my thesis around a new stock that I added in my portfolio this week. So I want to give you why I did that, and then you can frame your own opinion. I think this is the second stock that I've added new for this year. And of course, we are in the middle of, or maybe near the end of earnings. So this week was very heavy for earnings, especially, all the Max 7 big tech companies. On one particular day, we have like $6 trillion of market cap reporting all on one single day. So pretty busy week. This was for earnings. So we're going to go through some of the earnings. Like I have a Uber, Meta, Google, I think PayPal, and yeah. Also want to cover the topic that I think I hinted last week was around a private market. A lot of stuff happening on the private credit side, giving retail investors access to venture funding and private loans, CLOs, and all that. So as a retail investor, what you should watch out for? I'm seeing a lot of offerings coming out for retail investors. So a little bit want to talk about that. And of course, bit on the market side as well. So, okay. So that's on my side. What else you guys have? Anyone here joining for the first? I do see a few new names. Atul, is that your first time? Atul, you can unmute yourself, and I just want to understand, what brings you here? What are you looking to get out of this session? Okay, 1 second. Maybe I have to make sure my speaker is correct. Okay, try that again. All right, you microphone issues. So I'll skip Atul. I think another name, Tension. What brings you here? Looks like probably this is also your first time. Tension, you can unmute yourself, and I just want to understand what brings you here. You will be spending a couple of hours here. Want to make sure that is useful for you. So what are you looking to get out of this meeting? No, shy, don't want to share it. If you don't want to talk, that's fine as well. Maybe you can just put in a chat. Who else is here for the first time? Anyone else? Any other first timers? Okay. I just see Edgar. You want to share? What brings you here?
Hey folks, how you guys doing? First time here. Yeah, I actually work at one of those tech companies that you have on the screen, and I'm not too familiar with stocks. So obviously I'm familiar with like what stocks are and all that, but I'm not familiar with like the macros and where the strategy you should put and what you should look out for when picking a stock. So I saw this meetup and I was really interested, and I wanted to see how you folks pick stocks, what strategies you use, what things to look out for, and
Mhm.
yeah, that's why I'm here. So I'm just here hoping to learn more about things to look out for, especially during earnings, as you just mentioned. But yeah, but I mean, I've read a couple of books on options and how they work,
Mhm.
but just looking to learn more about trends and
Cool.
yeah, things of that nature.
All right. All right. Cool. Welcome. Anyone else here for the first time? Tensha says, I'm here to learn more about market options trading. Yeah, so in Saturday sessions, I don't generally get into the details of options unless someone have questions on options. But I mean, earlier this year, I did a boot camp on options. You can view the videos on my website. It's available for free. But if you have any questions around any of option strategies or something that you want to discuss, bring that up, and yeah, we'll take it up from there. Let's say if you want to talk about wheels, there are a few strategies which are very popular among retail investors: cash secured puts, covered calls, or you add both of them, become wheels. If you are to do especially earnings, maybe trying to just do a premium harvesting, things like that. The reason I don't bring in options in this meeting unless someone has a question is a lot of people are just, don't just stock investors. So I don't get into the details unless someone really have a question on options. Okay. So if you have a question, yeah, bring it up. Mike says, what is the topic? Uh, Maybe I answered it in terms of what I want to discuss. Sam said you watched something. I don't know what that share is. Atul says, I've been selling covered calls and making income from stock. Yeah, that's a good way to generate income and reduce the cost basis. One of my favorite strategies. And understand what people feel about valuation impact on inflation and debt. Yeah, so we will talk about it. Generally, when I look at a stock, I will when I build my investment thesis on a stock, there are two things I look at. One is of course, the story, and second thing is the numbers, right? That's where the valuation comes in. So for me, investment thesis is not just one part, not just valuation, but also what the story behind that valuation is. Yeah. So Mike says would like to know more about options. Okay, so let me just share the screen. So uh yeah, I do have a website where I post the recordings of these sessions, and you can come and get the options boot camps. I think I moved it under education. Yeah. So under beginner, like this is, I think I done in April. So we did almost 14 or 13 sessions around options, talking about every strategy, right from cash secured put, how to generate monthly income, strangle, straddle, butterflies, then how to use your delta hedging to hedge your portfolio, which I think nowadays will become very, when the market is all-time high, nobody thinks about risk management, right? So, and I think it helped me in 2022 if you hedge your portfolio. So I also talked about hedging portfolio, etc. So I think there are divided into three separate categories: beginner, intermediate, and advanced. So if you're interested in knowing more about options and my basic philosophy is to use it as a business, and not just try to swing it for the fences, because this is what I need to run my household on. So I focus on that way. Lower tax burden when I'm selling covered calls to take premium. This is that time when I feel the selling is already hit. Yeah, so when you're selling your covered calls, you definitely need to look at what if your stock gets called away. Are you gonna get hit with a short-term capital tax gains or not? If yes, then you figure out, is there a tax loss harvesting you can do? There is no other rocket science to it, right? So the other thing you can do is to pick up the right tax lot, right? So that's the other thing you can do to avoid the tax. Has anyone been doing long strangle for out of money? Not me, because that is like taking a lottery ticket and swinging for the fences. So that I don't do. I've been selling strangles because that gives me better probability of profit. Smaller dollar value, but more probability, and do it more times rather than I don't do long strangles. I'm mostly on the selling side. I don't buy options. Mostly 98, 99% of my trades will be all selling and not buying. Tensions, I want to learn more about option Greek. So I think one of the intermediate or advanced sessions is about option Greeks. So I covered all the 5 option Greeks. Now including Rho, because Rho has now started to show up its impact in the option pricing. We never talked about Rho earlier because interest rates were close to 0. But last 2 years, interest rates have become meaningful. So I did talk about Rho. It's one of those I think sessions in the boot camp. Let me just say it's in the advanced or intermediate. Oh, manage risk. Yeah, so that we talk about delta, theta, vega, gamma, rho, number 10 and number 11. How do you sell strangles? I mean, it's a sell call and a sell put. Does it cost a lot for seller strangle? It depends on buying power and what kind of a privilege you have. When you're selling, there is no outgo of cash, right? It's you receive a cash, but then the amount of buying power that gets consumed or gets blocked is depending on what kind of a privilege what kind of port margin you have. If you can't sell strangle, sell iron condor. Looking for option coach mentor. I don't do personal coaching, etc. So don't expect that I'll give you a call. I'm here. You have a question? Come and talk about it in the session. That's what the Saturdays are for. All right. Any other questions? All right. Let's get into today's session then. Looks like a lot of folks are more interested in options, but I want to make it clear. There are many folks who talk about options. You can see it on YouTube or any other webinars, mostly trying to swing for the fences. I'm not one of them. I don't buy options. I want to do slowly and steadily build wealth. Options is to protect my portfolio, hedge my risk, so that I can stay in the market for longer, right? 2018 drawdowns, that's fine. 2020 drawdown, it's okay. 2022 drawdown is still okay. You still survive. That's how I use options to increase my longevity in the market. So If you're trying to figure out how you can make 200%, not gonna get that from me. But if you're trying to look at how to get the best stocks, how to analyze the stocks and stay in the market for longer, reduce the risk, reduce the cost basis of ownership, so that we can let the market do its thing of compounding. We talk about it all the way. Do you analyze any company earnings? I'm gonna look at earnings. I think 3 or 4 companies today. Yes, we do. We do look at earnings. When I sell a call or a put, can I just buy it right away? So when you sell a call or a put, let me just give an example. Let's talk about, someone says AMD, right? So let's look at AMD. I'm going out to 48 days. And if you think AMD is a good, or you're bullish on AMD, but you want to give yourself a little room for error, you can sell a put at 130. You can collect $3.70 as a premium right now. But then make sure you're okay to buy AMD at $130. If AMD doesn't go below $130 by December, you anyway got your $370. AMD stays here, you still got your $370. If it goes below, anyway, you bought it at 130, which you were okay with, but you reduced your cost of buying by $3.70. So I've covered all these in beginner session in terms of how you use options. If you're just moving from stock to option, instead of a limit order, how you can just use options to buy it at a cheaper price than what's available in the market. Or if you're trying to sell your stock, instead of selling a limit order, maybe sell a call again instead of selling a limit order, right? Because you get paid while you're waiting for the stock to hit your limit price. Okay. Right. Yeah. So, thanks, Alfred. Yeah. So some of these basics I've already covered in these sessions. Feel free to go through it. Ping me if you have questions, or you can email me. Let me give you the email address. What I'm not going to respond is someone calling me, because I just don't pick up the phone numbers from the ones which I don't recognize. But you can email me. Cool. Alrighty. Okay, so let's dive into today's session. Any other question? I think, Sam, you're saying there is a German company. You always bring up some obscure, unknown companies that we have not heard of, which is interesting. I just want to make sure that you look at the whether the company is of high quality or not. Cool. Okay, so let's get into today's session. Today is our discussion number 254. That's almost 4.5 years, almost. Maybe we are getting close to 5 years. So thank you for joining in. And yeah, I mean, here for decades, not just for years. So this is just a start. So as always, anything that we discuss here is only for education or entertainment. Don't take it as a financial advice and go and trade or saying, hey, I heard Vivek talking about this, so it should be right. I should be buying this stock or doing this option trade, etc., etc. Do your own research, blah, blah, blah. Don't hold me responsible if you buy some stock. Okay. I will talk about stocks. I will talk about general market, but that's just my opinion. It may or may not work out for you. Investing is very, very, very personal. I like a stock. I'll hold it. Eventually, it may work out for me, but may not for you, because your needs are different. You are a different personality. So you have to frame your own thesis and own portfolio. Okay. All right. So with that, let's talk about get into today's session. But before that, happy Halloween, happy Diwali. Today, I mean, this week, we had both the festivals on the same day. So kind of a divided house. Kids want to go out and go for some trick or treating. And, as a parents, we want to celebrate Diwali at home. So we have to kind of, do both. It's a pretty busy day, or I would say it's a busy week overall. So that's why I'm a little bit falling behind on analyzing all the earnings, because for us, Diwali is our biggest festival for the year. So we got to have a lot of socializing. Even yesterday evening, we were at a friend's place. Today evening, we are again going. So this whole week has been like meeting and greeting people. But those who celebrate happy Diwali and happy Halloween. All right, let's talk about the market. Right, that's what we are here for. So market has been pretty resilient. Of course, we have our ups and downs in any particular week. You will see some of the not just the individual stocks. Of course, individual stocks move a lot, but even the overall market will give you a little bit of jitters. We saw some this week when I think was it the initial few days, the markets didn't perform. And eventually, if you look at October, we are back to where we started October. So kind of October has been nothing burger, right? So we closed October where, let's extend it out. So this is where we were on October, right? 568. And where does October started? 10-1. This is where we started. So even though October has been nothing burger, no change, but still we are up like almost 20% for the year. So pretty resilient. We would have never thought that, after the increase in so much of interest rates for now 2 continuous years, market will give 26% return in 2023, and then so far it's 20%. I think some of our previous sessions we looked at, there have been only 5 occasions in last 75 years where the market has done 2 consecutive years of 20% plus returns. So is this going to be the fifth one? We'll see. We still have 2 more months to go, and pretty volatile months because we got an election coming up, and anything can happen after elections. We don't know who's gonna win, but one thing which, at least if we look at a history, that tells us doesn't really matter whether it's Democrats or Republicans. Market eventually performs in the long term based on your earnings growth and the potential of the individual companies. And the markets have done good under both administrations. So I'm not much worried about elections, right, from a long-term perspective. But if the questions on maybe I want to hedge some of my positions for the short-term volatility in election, yeah, that I do, but I'm not like selling off my positions and thinking, oh my God, maybe it's Kamala is gonna win or Donald Trump is gonna win, and then take an action on the market, assuming, oh, it might crash. I've done that mistake once. I'm not gonna do that again. So I might do a little bit of hedging, but that's it. So markets have been pretty resilient. Economy, if you look at earnings growth, right? Third quarter, which is Q3, which is in progress, 70% of S&P 500 companies have reported results. And we are looking at earnings growth of 5%, which is above expectations. The market expectations were of around 4%. Full year earnings growth is expected to be around 9%. So 9% earnings growth in an environment where we had interest rates which are more than 4, like almost 5%, right? That's pretty impressive. If you were to ask me in 2022, when Fed was starting to increase the interest rates, hey, what do you think the stock market will do? The general conventional wisdom is, and that's what I think most of the Wall Street firms, the economists, the strategists, they all said markets probably we will enter into recession. Right? There were so many calls of getting into recession in 2023. The Mike Wilson, who was who won the award for the best analyst in 2022 because he was able to accurately kind of predict that the stock market will not perform in 2022, kind of almost lost his job in 2023 and 2024 because he still maintained his bearish thesis. So no one knows. No one knows how the market going to perform. Everyone have their guesses. If you have a good credentials, you've gone to Harvard, good school, you're working on a Wall Street firm, people will pay more attention to you, even if you may be wrong. Right? Once in a while, everyone's prediction will come true, even including my prediction will come true. But that doesn't mean that I have any more insight into what the market's gonna do, or anyone else has more insight than I have what market's gonna do. So I don't pay too much attention to or change my investment thesis based on what the Wall Street firms are saying, because they don't know any better anyway. Right? Every year we will find forecasters or analysts whom we will put on pedestal. Like 2022, it was Mike Wilson. 2023, it was 2021, it was Cathy Wood. 2022, Mike Wilson. 2023, it was Tom Lee. I don't know who's going to be 2024. Right? Tom Lee said that IWM or the small and medium businesses will be up 50% for the year. I don't know. Where is IWM right now? Right? It's up 9%. Right? So I don't think it's Tom Lee. But everyone's guess will come right once in a year. I haven't seen any economist or analyst who can be accurate consistently. Right? Then why follow anyone else? Right? Then that's you've been just lucky once in a while. That's why economists are not billionaires. Right? There's a famous saying that economists never mark to market their predictions, because if they do, they should be bankrupt. The predictions comes true only once in a while, right? But anyway, so markets have been pretty good. Looking at more importantly, and this chart was very interesting for me because, gosh, we already did 26% in 2023. We are now close to 20% in 2024. Are market going to perform next year? It's been maybe, I think, once in 75 years. I forgot what was the number. We looked at these stats 2 or 3 or 4, maybe 3 sessions ago. Maybe once in 75 years, or maybe never in 75 years, that we had 3 consistent years when the market has returned more than 20%. Right? But so I was thinking maybe 2025, maybe we may get a bear market, right? Again, I have no insight into it. But if you look at the earnings expectations, I got it today morning. I'm like, wow, we're expecting earnings to grow at 14%, 15%, almost 15%. And what drives the stock market is your earnings growth and multiple expansions. Couple this 15% earnings growth with the fact that Fed may reduce the interest rates, which will give rise to multiple expansion. We might be for another bull run. Again, I don't know. We can only guess. We can only surmise based on the numbers that we see. Right? There are so many factors involved in the markets that you never know where it will go. But 14% earnings growth, if it's being expected, then the markets may either. The other way could be maybe markets are front running this expectation and hence it is all-time high. Possible, maybe. Who knows? But 14-15% earnings growth, I was not expecting this. So I was pleasantly surprised that the growth is expected to be so much. Sector specific, I think no surprises here. Tech sector continues to outperform in terms of its earnings growth. And that's the reason why the valuations of the tech sector, Mag 7, stays elevated. Right? Because they've been performing, and I think they'll continue to. The expectation is that they will return almost 22% earnings growth. Healthcare, that's interesting. And financials and the real estate, again, looking at 2025, expectations is that they're not going to perform as much as, some of these healthcare and in IT and industrials. Even if you're not sector specific investor, S&P 500 15% is a great great return anyway. What else? Job numbers. So we had some job numbers this week, and which was horribly below what the expectations were. Uh, I don't even know how much we should even put faith in these numbers, because the numbers get revised after in the next month, and we have seen some of the revisions were like way off. Yeah, 5%, 10% error rate. Okay, we'll grant you, right? But when the error rate is like huge, on one of the month we had what, 800K revision. So anyway, so this week when the numbers came out, the job growth added was like 12,000, and the expectation was almost like 100,000, right? And there we talk about economists that they don't know much more than I guess you would, right? Even economists, PhDs, are off by 90%. Talk about the, trying to guess the direction of the market. We can't even get the numbers of heroes right. And how can we even tell what the market's gonna do? So job numbers were not that great. The question which I have for you all, it's been 2 years, and there have been a couple of indicators that market thinks that they are closer to predict the recession. Again, no one is perfect, but there are a couple of indicators which are better than others. One is, of course, the SAM indicator, which became very popular this year. No one was talking about SAM indicator 2023 or 2022, but then I saw Claudia Sam. She's the inventor or creator of this indicator, was being interviewed on financial medias and the podcasts. And she came up with this indicator, which kind of has accurately predicted all of the previous recessions. The shaded bars you see are the recessions. So now, so basically this indicator looks at the unemployment situation. And if this number is more than 0.5, which it was in this case, when it is rising and goes up more than 0.5, you enter into recession. Same case here, same case here, same case here. So the question was, are we going to get into recession? And that's what when the indicator went up to 0.5 here, the market has started to predict maybe we'll get into recession. This is despite the fact that Claudia Sham said, maybe my indicator probably will not work this time, because the economy seems to be strong, the resiliency, consumers are still spending. So even though the indicator is above 0.5, maybe we will not have a recession. Right? This came from horse's mouth, from the creator of the indicator. Right? But rest of the market was like, maybe we'll get into recession, and we saw, markets reacting earlier to these recession fears and all that stuff. So this is one. Another one is yield curve. I think it may be a little early to talk about yield curve, because after the yield curve uninverts, it takes around 12 to 18 months. So we've started uninversion very recently. So maybe we'll wait to see if the yield curve inversion is a good predict, will continue to be a reliable predictor of a recession. So far there's no recession seen. Looks like in 2025 also, looking at the earnings growth that market is expecting, we don't think that we'll get into recession. But what do I know? We'll see. But if you were thinking to liquidate your portfolio or move into cash. Some of these numbers around earnings, etc., might help you to make a decision. Right? I see a question, how accurate is that indicator? It's only in hindsight we'll get to know. So there are two indicators which, so prior to SAM indicator, yield curve was the only one which you could say was a more reliable indicator or predictor of a recession than anything else, right? So basically yield curve on inversion. So when yield curve start to invert, markets think, oh, maybe we'll get into recession. And all these recessions were preceded by inversion. And then after uninversion, you see these recessions will come in. So this was the most reliable indicator. Now, have there been a negative cases wherein the yield curve had uninverted and we didn't get a recession? Yes. For example, this was the case where we didn't get it. I mean, we actually got it a few months later. Where else? Maybe this was a case where we didn't get it after uninversion, but it didn't stay inverted for too long. Right? So, but again, in hindsight, we'll know. Second thing to look at is that the macro and the role of the central banks has changed a lot from what it used to be. Right? After 2008, pumping liquidity in the markets had become their default modus operandi. We never had that kind of a Fed before. So the situations have changed, things have changed, but you know what? The market pundits want to look at a numbers, charts, trying to predict the markets, trying to predict the future. In that case, yield curve was touted as one of the more reliable indicators, and from this year we start to see the SAM indicator. I don't blindly follow any of these. Again, I've said we will have a recession. We will have a stock market crash. That's given. I am fully prepared for a 10%, 20% drawdown every 3 years. And if you build your portfolio like that, in which you can still withstand those drawdowns, and why do you care about what their indicators do? Right? So rather than me trying to rely on indicator, I would rather build my portfolio in a way that, if you have a drawdown at 10 to 20%, yeah, I still don't have to, I'm still in the game. So that's all I'll focus on. Atul says 2024 Stacey Jackson or maybe Dan Ives, right? Both are kind of the same analyst. Dan Ives is like uber bullish on all the tech stocks. Talk about Tesla. We don't know. So every year brings up its own super analyst or market pundits. So it could be Dan Ives. We'll see. So overall markets, so how the market is doing, economy seems to be pretty resilient markets. Yeah, I think every sector is green, except cash. If you had put money in any sector, I know for a few months the energy was negative, but now if you put money in any sector, if you are energy, like who was that who says he works in the tech company? I think Edgar, right? If you're a tech company, you understand the tech sector. Maybe you invest in tech. Yeah, you've done great, 30%. Like communication and information tech is almost 30%. Okay, guys, I don't understand tech. I'm in a financial services business, so that's where I want to focus my investment on. Financial service sector is 23%, 24%. If you're a real estate guy, and if you invested in the real estate S&P, that's up 6%, 7%. Right? Energy is up like 5.5%, except cash. If we've still been waiting for the crash so that we can invest when the crash happens, good luck. Right? Timing of the market has never worked in the long term. Time in the market is more important than timing the market. So pretty good market, pretty resilient markets. And we got 2 more months to go. So let's look at how the markets have performed in election years for November and December. So 60%, 2/3 of the time, November has returned a positive for the markets when you have an election year. Can you believe? That doesn't mean that this year is going to be positive, but these are just a probabilities, right? Maybe this year could be the 1/3 where it doesn't return positive. Who knows? But 2/3 of the times November has returned positive, had positive returns, and almost 85% of the times December had a positive returns as well. So let's say if we assume that this election year is no different from the election years of the past since 1952, then we're looking for another, maybe a couple of points of gains still remaining in SPY. Again, no guarantees. We can only look at what has happened in the history and draw some inference or, try to project it out in the future. But yeah, if November and December, seasonally November and this Q4 is generally positive for the market, but because this time we have an election, so we can't really look at it as a normal normal as a general year. Even if you look at the election years since 1952, 61% of the times November is positive, 83% of the times December is positive. Right. I see a question. Do you look at the cryptocurrency markets? Yeah, I'm probably today I don't have it, but if there's something new that has happened in the currency market, like last week we talked about how Microsoft proxy statement has got an allocation for Bitcoin. If you have a question on, I only look at either Bitcoin or Ethereum, a few top ones. I don't do NFTs or meme coins. But if you have a question on any one of those, yeah, bring it up. And if I don't have a time to focus on these this week, maybe I'll read about it, and we can talk about it next week. But I didn't see anything much happening this week except the fact that I think Bitcoin almost hit the 73,000 high, and then I think it came down. Beyond that, I didn't see any material new news around the protocols, etc. Of course, if you are interested in that, the one very unusual earnings call that I listened to was MicroStrategy earnings call. For 90 minutes, Michael Saylor was talking about how MicroStrategy has become a Bitcoin proxy for Bitcoin. That gives him a little bit of a jittery, made a little bit nervous because it's like you're leveraging on top of leverage. I don't know how that will end up, but yeah, if you're interested in that, you should listen to him. He's kind of trying to pitch in why, Bitcoins continue to go high, and he has a plans to buy $42 billion worth of Bitcoin. Right? Sell equity and raise debt just to buy Bitcoin. But that's the only, I think, big stuff that I noticed in the market. So yeah, other than that, I don't think I have anything. So Edgar, if you have anything specific on a crypto, yeah, let's talk about it. Can you please talk through your thought process TLT? Yes, Alfred said, yeah, I did talk about TLT of why, I'll buy a little bit of a TLT. All right, so long-term markets do good, but shorter term durations, I think this is a weekly chart. You see a lot of reds. And if you hold Microsoft, Nvidia, or Apple, that might cause you a little bit of a heartache. What's happening? your stomach might churn a little bit, but that's why this is, I mean, we shouldn't focus on what's happening week to week or month to month, or maybe even in a year, right? If we're here only for a year, I don't think the stock market is a place to make money for a year. So get my general investing thesis is, if I need money, if I need to make money, or I need something for the next 2 to 3 years, I'm not going to put it in the stock market, plain and simple, because the market can go down once in every 3 years. Maybe it's the next year that will go down. Who knows? Right? Or maybe we'll have a 3 continuous bull year and then we'll have a bear year. So I don't want to just focus on next 1 to 3 markets. Then there is always a smart sounding reason to get out of the market. There's a pretty interesting chart. Anytime when you think about, oh gosh, the market's, there's a tension in the Middle East. Russia had attacked Ukraine like 2 years ago, right? And then so almost a year where we have been having a conflict in Middle East, right? US is into recession. Things are not looking good. Look at since 1950s. We always had so much of a scare, war, debt crisis, bombing, housing slump, dot-com crash, great financial recession, 2018, interest tantrums from the banks and all that. Yeah, but human ingenuity, since we moved out of our caves, we've always been progressing, right? That's what human ingenuity is. And if we continue to invest in human ingenuity, and now market gives us a way to invest, then I don't have a reason, to say that markets won't continue to go high in a long term. Short term things will happen. Short term excesses will happen, have happened always, right? Right from tulip bubble to South Sea bubble to 1929 depression, we had a lost decade sometimes. But despite all that, S&P still has done nice. So something to look at. Meanwhile, I saw an interesting chart. This is a little more fun in India. A stock from India. 1 day return or whatever. I get it, like 6 million%. This stock was trading at 3 rupees 50 cents. 50 paise, which is equivalent of cents, right? You can consider $3.50 to $236,000. Any of my friends, if anyone is investing in India, were you lucky enough to have this? Right? Especially in my, some of the friends that I'm connected with, they just reached out to me. What the heck is happening? I don't invest in Indian markets. I don't know. But this is not a meme coin. This is not an NFT. This is an investment holding company. If you're interested in this, Google for it. There is the stuff that has happened in India is stock exchanges have asked, so stock regulator have asked stock exchanges to do an auction to figure out the fair value of investment holding companies, which I don't know why they should do it, because the pricing and the valuations are two completely different things. So this particular company, and I think let's talk about it because this will be useful in from a knowledge perspective. Even though it doesn't apply into US, it doesn't happen in US. So this LCID investment company, it's an investment holding company, means it holds the shares of other companies. So it has the shares of a very successful an Indian stock called Asian Paints. And so let's consider you got a Berkshire Hathaway, or let's say XYZ. I open an investment, a fund, investment company, and I own a big chunk of, let's say, Apple shares. Okay. And I own, say, $10 million worth of Apple shares, but my stock of Vivek Investments is trading only at $100,000. What gives? So this is what was happening. So this investment holding company hold the shares of a publicly traded company, and their shares were worth a lot more than the shares of this investment company is trading. So, and there are many investment companies like that. Now, the coming back to example of Vivek Investments, yeah, the value of the shares that I have in my investment company is $10 million. Those are the Apple shares I hold. So why my company's share price is not reflecting it? Because there's a difference between pricing and valuation. My shares are very illiquid. Even though theoretically it is worth 10 million, but if you can't trade it in the market, then it's worth zero. So you can pick any number between 0 to 10 million. So these shares, LSID investments, in last 10, 11 years, traded only twice or thrice. Right? So what stock exchange, the regulator in India asked stock exchanges to do is to conduct an auction so that we know what the fair value would be. And I was like, why the hell you do that? What good is this fair value if you can't even trade it? So that's the reason. And this is one auction that was conducted. They have a list of, similar companies and when that auctions will be done and to figure out a price discovery. And I'm like, why the heck is even regulator getting into these things? So, but that was the fun. So from an education perspective, there's a difference between the valuation and the pricing. When it comes to the pricing, a lot more factors will come into picture. That's why if you look at a close-ended mutual funds, they trade either at a premium to their values or at a discount to the value. This is exactly what was happening in these shares is because you can't freely trade it, there is no liquidity. It was trading at a huge 99.9% discount to the value of the assets that it hold in itself. During the crypto boom and the bust, we have seen similar things. GBTC, Grayscale Bitcoin Trust, which holds Bitcoin, was trading in the boom market. It was trading at 50% premium to the amount of Bitcoins it hold underneath it because it is closed ended. And in 2022, when it was bust, all the crypto market was like in bearish phase. It was trading close to 36%. I bought some GBTs at that point of time. It has 36% discount to the value of Bitcoins that it held. My thesis at that point of time was if it gets converted to ETF or the markets recover, you have a straight up 36% chance because it will match to what its net asset value is. So these things always happen in a closed-ended mutual funds because those are not that liquid. Same was the case in the shares. So difference between valuation and the pricing. A lot more things come into picture when you talk about the share pricing than just the valuation stuff. But this was an interesting phenomenon. I'm like, what the heck is happening? I have seen Japanese regulators or stock exchanges recommending companies, but in terms of taking some actions, but I've never seen any regulator of a well-developed stock market actually forcing stock exchanges to conduct these kind of auctions. Anyway, something new that I learned this week. So coming to our fear and greed index, last week we were greed, now we are neutral. I will still watch and wait. Me personally, you can do whatever works for you. Before I go become a little bit bullish on the market. I want to be bullish on the market when there is fear. Right? Go out when there is a blood in the market. Go for shopping when the things are available at discount. And stay back. Watch it. Watch from the sidelines when everyone is going gaga over the markets. So a quick update on my portfolio. What did I buy or sold this week? Again, these are not recommendations, but because I talk about stocks, I just want to be open in terms of what I buy or sell from a transparency perspective. So I bought XLE. I bought a little bit of Arista Networks. So Arista Networks was the first stock, I think a new stock that I added in my portfolio for this year. And the third one that I'm going to talk about is a new stock that I added in my portfolio. Did anyone recognize it from the logo? What's that third stock is? Let me show you the logo once again. A new stock thesis. Does anyone recognize this logo? Any guesses? All right, so we'll keep it a surprise then. So let's go back where we were. Okay. Yeah, so a little bit for energy ETF, Arista Networks, and the new stock. I didn't sell any of the stock, though I do a lot of option trades. I did a lot. I think Friday was pretty busy. I clocked in almost 20 trades after a long time. But because it was also, expirations and all the trades that were expiring that day, I had to either roll it out or close it, do whatever I need to do. So, but no stock buy or sell. So end of October, this is how the pizza looks like. Okay. Again, not much change in the top 15 from what was in September. The top one is still SPY. I don't think this will change because I'm not too comfortable to make one individual stock huge part of my portfolio, but I'm pretty okay with SPY becoming 20-25% of portfolio. So that's fine. It's now 13%. Cash is almost 6%. Mercado Libre continues to be my top individual stock holding. It's been for, I think, almost for the whole year now. Apple, Meta, ACHD, it's an ETF. Google, Microsoft, QQQ is back in. It's an ETF. Amazon, Berkshire Hathaway, IWM, Nvidia, Palantir, Shopify. So what changed from previous week? QQQ is back in, and the reason is like every week I tell you what did I buy. I had a short call on QQQ, so that was assigned. So that's why QQQ had fallen off the top 15. Throughout this month, I was just buying back the QQQ. So it's back in top 15. And then who went out? It's ASML. ASML in September was number 12. And end of October, it's not even in top 15. And shouldn't be a surprise because the ASML stock chart is not pretty. And if you're looking at where it was in September, let's bring up ASML. ASML. So we're talking about end of September is close to here. Yeah, 930, right? $833. Now it's down to $660. Given up all the gains for the year, now it's turned negative for the year. So not a pretty stock chart. If you are looking at a stock price, not a good stock price to look at, but it's still a great business. And I still want to own it, like owning it, and I'll continue to own it. Not in my top 15 because of what has happened to the stock, but business-wise, I don't see any change. They still have the monopoly on EUV machines, and we will need chips. Oh, that reminds me. I also went through a new McKinsey report that talked about 18 sectors for what's gonna expected to grow for the next 2 decades, right? So maybe next week I'll cover that. So as an investor, we need to look into what's coming in future, right? So, and some of those sectors will continue to be the same, like e-commerce will still be there, but some of the new sectors maybe, next 10, 15, 20 years could be new growth engines, right? So yeah, maybe not next week. Again, next week will be earnings. So maybe week after that, I should cover that report, give you a summary of that report in terms of what are the next growth sectors for next 20 years. Then we can start finding those companies and start to invest in those good businesses. Right? So ASML, I think I still a great business. I still want to own it. So I'm not sold any of the stocks of ASML. In fact, last week, I shared that I bought when it fell down to 700 or 720 or 730 is what I bought it. Now it's again down. That's fine. The stock can go short term, it can go wherever it wants to. I'll continue to sell premium and reduce my cost basis on it. I think was it last week, someone had asked on in terms of how I distribute my portfolio. So 70% of my portfolio is in the core. And I consider core are the companies that are actually are profitable, high, market cap companies and the ETFs. That's my definition of core. That XLE, I'll put it in the core because hey, it's an ETF. I don't think that it's or I don't think it's gonna go down like 20% in a day, stuff like that. So some of the ETFs are core part of my core portfolio, plus some of the good businesses are part of my core portfolio. That makes us 70% of my portfolio. Growth are the other ones which, their companies that are a little risky, but they are in their growth phase. They may not make money right now, right? Because they're reinvesting everything into the business to grow the business for future. These are like and maybe half of these growth companies will become bankrupt in future. That's why it's a 30% of my portfolio. And then the third one is the moonshot. May not even have a product yet. They may just have a plan. Or they are like companies which are still in if it is in a regulated space, if it is in a medical space, they are still waiting to get approval from FDA. So there's zero revenue or maybe very little revenue, right? So those are the moonshots, very small portion of my portfolio. All of those moonshots could go to zero. So that's how I kind of distribute my portfolio across different type of companies, right? So let's say when I come and talk about saying, hey, I'm interested in this company. The question that you should ask me is where is it falling? Right? If it is in a moonshot, if the company is still in a growth phase, then I'm not going to put 5% of my portfolio in that company, right? So the sizing matters based on what kind of a company it is. Right? If it is a moonshot, probably I'll only have 0.1%. Maybe I'll put 0.5%, maybe 1% of my portfolio in that. Right? The trouble becomes is when we know about a company because we saw an analyst talking about that company on CNBC or Bloomberg Pickup or whatever channel. It says a great company, it's the next growth engine, this is what the future is going to be. And then we go and put 20% of our portfolio in that company. And then the company tanks, and then we start blaming the analyst, or we blame these Wall Street firms are crooks. They basically fleece retail investors. Oh, market is not for us. No, man, we don't know. We have not sized the position according to what the company is. Position sizing is the most important thing when you try to build your portfolio, whether it's options or whether it's long stocks. For me, position sizing is very, very important. So moonshot, yeah, if it goes to zero, that's fine. I'll survive. I'll be okay. Even if half of the growth, like I said, if it goes to zero, still be okay. What you shouldn't do is that I bought something which I consider as a moonshot or a growth, and you go and bet your house on it. Well, that's where we start our problems, right? That I'm still okay, or the other way around. Or if you bring in a company and then I invested without even understanding what phase is that company in. All right. I see a question. Atul, is it a good to close at expiration when I'm selling covered call and is about to expire worth less or roll? It depends if you still have. I mean, what's your outlook around that stock? I mean, if you really hate the stock and want to let it go, then maybe roll it out. Or if your only idea was that I want to just do a premium harvesting. I still love the company, but I want to do a premium harvesting and continuously reduce the cost basis. Then I don't even wait until very close to expiration. So I'll wait if it is, I'm making like say 50 to 60% of the maximum premium. For example, if I sold a covered call and I got collected $5 of premium, right? I probably will close it when the same trade is now trading at $2. I'll close the trade. And because by that, it will be close to 2 to 3 weeks for the theta to kick in and for it to reduce to $2. And then in the last 2 to 3 weeks, we have a lot of a gamma rays. Now, if I made 50 to 60%, I don't want to take that gamma risk. I'll probably put in another one for the December, right? You roll it to December. So this is how I make a decision. Just remember one thing, the closer you get to the expiration, you have more and more gamma rays. Your positions will move very fast depending on even a small movement in the stock price could change your option positions by a lot because you have a very high gamma as you get closer to expiration. So I try to close out any of these, much before expiration. Now, things that I still carry on expirations are like my hedging positions, right? I have a short calls on QQQs, and I'm like, that's fine. If QQQ continue, if market continues to go high, my rest of the portfolio is going, these are my hedging trades. But other than that, I would, if it's a premium harvesting, I have a 50 to 60% of my price target. When that is met, I'm out. That's how I'll do it. Okay, most anticipated earnings next week. A lot of earnings still coming up. I thought we were done with it, but no, a lot of stuff that I'm interested in is still going to report. So Berkshire Hathaway, I think they already reported because I saw some tweets around their operating income, but I have not had a chance because since morning I was busy to prep up this doc. But Palantir reports on Monday, Hims and Hers report on Monday. Tuesday we got a SMCI. The AI darling. We'll talk about it a little bit. Again, I don't own this. Coupang reports on Tuesday. And then Melly reports on Wednesday, ARM, which is I'm interested in. And Thursday going to be a busy day for me. Arista Network, Square, Trade Desk, Pinterest, Airbnb. So I guess next week is still going to be busy week. Hopefully, at least we don't have two festivals next week. So I'll be able to spend time. I still have to catch up on a lot of earning transcript from this week. So I guess gonna be pretty busy week next one also. So let's talk about, since I gave an intro to SMC, let's talk about two tales of 30% plus drops, right? SMCI, and go back and look into some of the previous sessions. Some of you have brought up this company because it was just continue to go up. Like, why are you not interested in it? Or what's your thesis? And when we reviewed the companies, and you can go back and look at the videos, I'm like, I can't understand why this company is valued so highly because it is not a software company. It's a more of a consulting. It's a assembly of a hardware company. The number shows it that their operating margins is like 10%, 11%. Whereas you're giving it a valuation of the SaaS companies where your operating margins are like 40%, 50%. Just doesn't make sense. So anyway, things are starting to unravel. Right? And the stock fell down 30% in a day. And then there was a short report that came out from Hindenburg. I think it was in August or September. And so the signs were there, right? The signs were there to, if you are willing to look into it, that there's something wrong going around this company. Number one, it doesn't deserve whatever. I mean, that you can't blame on company. Maybe the whole market got crazy. And I still tell you, there were Wall Street analysts who had given a valuation of, I think, 250. Now the stock is at what, 26? So, but that happens. Many analysts will just chase the prices, right? Was never able to wrap my head around the fact that why such a low margin business is being treated at a same level as a high margin business, which is like Nvidia, or pick up the other companies. But in any case, a board member had resigned. Company in a few years ago was indicted by SEC because of accounting malpractices. It had gotten delisted from NASDAQ a few years ago. And then they rehired the executive who was who was a like focus of that indictment. What else? Oh, how many more indicators do you need before you decide, gosh, there's something going wrong with this? Now, despite all that, if you were like, yeah, I'm invested in this because it's going up, don't blame the market then. Don't blame the market. I mean, we all are adult here, and I hate when I see comments either on Twitter or LinkedIn saying these Wall Street firms they just work for their rich friends and are against retail investors. I'm like, who asked you to follow these Wall Street analysts anyway? Who asked you to follow JP Morgan when they were trying to sell you WeWork at $42 billion? I think it's a real estate company being disguised as a tech company. We got to do our own homework. And that's my endeavor here is to, hey, as a retail investor, we need to be educated. We need to figure out how to look at these companies and make our own decisions. So glad that we never picked up SMCA. Actually had a negative delta trade, but I closed my short, position in it when the stock was at 425, means $42. If I'd held it, probably would have made more, but who knows? I'm happy with what I made. In any case, so this company unraveled, Ernst & Young, their auditor resigned. Auditors generally will never resign. Auditors will work until the last dying moment because you pay the auditor. And not only they get paid for auditing fees, there are a lot of other businesses, like all these big four firms, right? They are not just auditing firms, they are IT consulting firms. They are other tax practice firms and all that. And when you are working with a company, even though they hire as an auditor, but you always there's a conflict of interest because there are other businesses that you can sell to that company. So auditor will work till their last dying moment to build and keep a relationship with you. And when an auditor says, sorry, I'm resigning, which I can't believe you can imagine how bad the things are. Ernst & Young sent a letter to SEC saying, guys, we are resigning. We don't want to be auditor of this company. So here we go. So that was and if you think it's a value play now, maybe it was 120 a few months ago, now it has 26. Maybe we should pick it up because available pretty cheap. I mean, do your own due diligence, guys. Do your own due diligence. So the other stock that also fell 30% after earnings, which is the TMDX. Anyone aware of this stock, TMDX? Any TMDX shareholders or anyone? Has anyone heard about this stock before? Jay says heard of it. Atul says no. She says yes. Blood transport, kind of. No. Yeah. So this is one of a stock that I had on my watch list for many months. I mean, I have a post-it where I have a watch list. I crossed ANET from that because now I own ANET. Now I also crossed yesterday. I also crossed TMDX because I started a position in this. So this is the new stock that I added to my position this week. And I quickly want to go through, gosh, only if I can pick up the dog. Give you my reasons of why I own this and give a little brief on what this company does. Again, I've just started it's a keep on a radar position. Okay, so I've not even built up my full position yet. It's just a keep on radar position because it fell down 30%. I'm like, now it's available at much cheaper rate than what it was like at 180. Right. So I quickly, I was actually on my post lunch, I was listening into an earnings call and I was on a walk. And then I realized, oh, the stock is down 30%. This is my first or second aftermarket purchase for this year. So I bought some shares during the aftermarket. So let's spend a next 15 minutes, try to understand what this company is. I'll give you more update once I finish my full analysis. Right now, I've only looked at 2 years of annual report. I've yet to go through at least this year's of all earnings. So let's talk about what this does. TransMedics, right? It's been a favorite of a FinTwit companies. Yeah, I bought it, started in 97. We will go through that later. Let's first try to understand what this company do. So this company is in a business of transforming the state of how the organ transplant industry works, right? So today, if you were to transplant an organ, you have to move from where the donor is to the place where the recipient is. The most, used way, or the way that we have been moving these organs, is basically pack it into the dry ice, right, in an ice box, and then you move it to where the recipient is, right? That worked for many years, but there is a better way to move it. Now, the problem with those is, we'll get to the problem. Okay, so let me not jump the gun. So what's the problem that TransMedics is trying to solve is that we have a lot more organs which are being donated, and most of those, 50% of those organs that are being donated actually not getting used. They go waste, which is like almost a crime. You can let a human organ go waste and not utilized, right? So here's some stats. Total owners, so the donors in 2023, let's say close to 16,000, and the total organs that were transplanted from the donors were only close to 8 or 9,000. Right? What happened to other organs? They just couldn't use it, because by the time they reached at the place where it needs to be, where the recipient is, they were not in a position or in a shape in which those organs could be used. Almost 50% of the organs which are donated are not being used. So how do we solve this problem? Right? So what are the historical challenges? Sometimes the plane is not available. Sometimes the plane is not available. You can't transport it. Cold storage gives you other stuff, is like donated organs on ice remains viable only for a limited amount of time. Right? Because they don't have any blood supply in it. So it could result in a permanent organ damage. No organ assessment while it is during the transportation, right? There is no way for a surgeon to assess where the organ is metabolically still okay or not. Right? So what TransMedics started to do was to address this problem. This company has been around for 25 years. This was founded in 1998. What they have developed is something called OCS, which is Organ Care System, which basically are these kind of big machines in which not only you keep the organ at the right temperature, but you basically provide it in an environment as if it is inside human body. So it has got three components, this OCS system. One is, of course, the console, right, which controls the functions of the whole OCS system. Most important is a perfusion set. So this basically pumps basically circulate the blood through the organ as if your body would circulate if the organ was still in the body. Right? And the third one is the solutions, which will basically provide a set of nutrients that is required for your organ to stay in an optimal condition outside the human body. So net, and this is my understanding, I spent only what 2 days on this. That too not 2 full days. But my understanding is they are trying to build a system which will replicate the conditions that exist inside a human body while the organ is in, has been taken out and is being transported. Right? So that's what they do. So of course, to do this, they need to have the blood pump, they need to use the thinners, they have gas exchangers to show that you have oxygen concentration and all that stuff retained. What are the key advantages? Is because of the warm blood perfusion, that organs are maintained in a living, functional stage and they preserve it for much longer time. Organ assessment. Physicians can monitor and assess the viability of organs while it is in transit. Yeah, that's still good, right? The third one is, if, of course, by replenishing the organs with oxygen nutrients, the health can be optimized during transport. So you reduce the instances of your organs being damaged while in transport. So that's their main core system, is organ care system. Now, then they build out the whole set of services around that. Fine, you got a OCS, but how are you going to transport the organ, right? And how about the overall ecosystem of, you have to basically donor center where the organ is being, taken out of a body. Then you have a transportation. During the transportation, you make sure that the organ remains in a healthy state. Then you go to the transplant center where it will be, transplanted into the recipient, right? Who's going to manage the overall end-to-end system? So for that, what TransMedics has done, they basically have their national OCS program. They work with these clinical centers and they manage end-to-end logistics. So they, in fact, so when I read about this company, I mean, I know about this company in 2023, 2024, they bought an airline. I'm like, what are they doing with the airline? Because no company has actually made money in airlines. Right? Airlines is a very bad business. Even though it has changed our lives, it's a bad business to make money. Investors have never made money in airline. So I held back. I'm like, what the heck? They bought an airline. But now I understand the reason why they bought an airline is they want to not depend on, I mean, the time it takes to transport itself is very important factor, right? So they don't want to depend on availability of planes from third party, but they want to control that part of the overall life cycle. So they bought an aviation companies. We'll talk about it. They have like 18 aircrafts now. So how do they make money? Let's talk about money. So that's about tech is great. Mission is good. They can increase the longevity of the organs and hence, 50% of the organs won't be wasted. But how they make money? Who are their customers? Transplant centers and the organ procurement organizations. So the way they make money is they give the OCS. I think to some of them they sell it. Otherwise, they just give the OCS for free. But they generate revenue from the sale of disposable sets, right? Your solutions, syringes, needles, and all that. Basically, it's like a razor and a blade model. Just like you have a Gillette had that. More recently, Intuitive Surgical works on the similar fashion. Da Vinci, you just use the consumables in it. Sale of console itself, to a lesser extent, they also sell those OCS consoles, right? But majority of the revenue come from the things that are used in OCS console. So if I'm an organ transplant center and I'll basically have their console with me, but I use the solutions and the perfusion sets and all the disposable stuff to take the organ out and preserve it and then transport it and all the stuff. Then they also have a revenue from services, right? Generate some service revenue. So what's my take was that they basically employ a razor and blades business model. And by basically enhanced service offerings, they sell the machines, but then they have a lot of disposables, which means if once you bought a machine, you will continue to use those disposables. What are the strength and the modes? They are the, I don't think they're the only FDA approved. I mean, I'm not yet, they claim that they are the only FDA approved. I've not yet found out if there is anything else or not, so I can't say right or wrong in either way. But they claim that they are the only FDA approved portable multi-organ warm perfusion platform, right? Uh, Not only they have a OCS system, they have an end-to-end national OCS program to have a more efficient process to procure the organs from the donors, move it all the way to the recipient and have it implanted in the recipient. Then they also have a significant, I mean, they have done clinical studies and they have evidence which proves that the OCS indeed help in maintaining the health of organs, and hence once it is implanted, the chances of body rejecting that organ, post-operative complications are heavily reduced by using the organs that are transported or through the OCS. Okay, but I'm not going to go through the whole of them. What are the competition? They may not be the only one. So there are two companies which they mention in their annual report are the competition. One is OrganOX, but it's not a listed company, and they have only liver perfusion. So they don't do heart and the lung. They only do liver. The second one is Ex Vivo Perfusion. It's in Stockholm, again, 25-year-old company. They have a liver and kidney, okay? But they don't have a heart. So, but they don't, I mean, it trades on OTC in US if you want to hedge and say, I want to do Ex Vivo, but not much of a volume. So in the US publicly listed, this is the only company. So I asked ChatGPT, you have to go outside to do your own research also. I asked Google and the ChatGPT, you tell me which are the other players. So obviously ChatGPT hallucinated and brought me the names which are not really into this, but adjacent. So I trimmed all that off. And these are the other names which he gave me, which is one related to the transport companies, but they only do transportation. They don't do the organ preservation stuff. TransMedics now 2024 also do transportation. And then they talked about these two companies, Paragonix and OrganOX. OrganOX we already seen. The other one is Paragonix. Again, none of them are publicly listed. So not huge. It's not a very crowded field because it takes a lot of, I guess, because it takes, number one, it is regulated. So it's not that you can just go and build it quickly, right? Software, you can probably build it, hire the best developers or poach a company, and then you're done. When it comes to regulations, especially when it's related to medical, it's a long gestation period. Right? So financials, it's still in a growing phase, so it's not optimized for being profitable yet. Management doesn't think that profitability and generating free cash flow is what they want to focus on, which is right. I mean, the phase at which this company is, I think that's a fair thing to focus on. So I've not done you have seen those usual, my metrics around how to identify the great quality companies. So there's no point in doing that. There's no point in running it through a valuation framework, right? Running a reverse DCF because it's not even optimized for profitability or free cash flow generation. So how will you value? Right now, only based on the storyline behind it. There will be a time when we will start to bring in the numbers, not just yet, right? So this I will put in a very early growth company. Debt, they have a 60 million debt from CIBC, and they have raised 460 million by doing a convertible. That I still have to work through the management team and compensation. Two risks. It's a regulated industry, right? So and this is one area which I don't have much familiarity with. I generally tend to stay away from the reason I don't have many healthcare companies is because I don't understand, tomorrow what will Medicare approve or not approve it? You never know. a government change could change the policies in which organ transplant companies, means their customers, could get paid for operations that are being conducted under purview of Medicare. And our medical system is so convoluted, that is very difficult. So that's one big risk. Number two, there were fewer and larger customers, right? It's not that the risk is, but it is a risk, not a huge amount of risk. I think I can live with a fewer and larger customers, but something which is regulated industry, medical stuff, in which I don't have much strength. So I'm not gonna like put 4% or 5% of my capital in this because I'm not very familiar with this. But if you are, maybe you could decide it other way around. So these risks are risks which I feel as an investor for me in this company. They did a couple of acquisitions. Summit Aviation is the one through which they now own airplanes, mostly in US. In total, 584 employees, up from 212. So I guess the other employees came from Summit Aviation. So it's not a huge growth. I think it's because of the acquisition, I guess. Any contractual, yeah, so they have interest in principal payments. I don't think any issue around that. Related party, could be because one of the product director is sister of the CEO, right? They have to disclose, are there any related party transactions? You can see if you want to, how much weightage do you want to give when you're building your investment thesis, but I just want to share that. Acquisitions we already covered. I still have to get through the financial overview, run scoring sheet. I have to go through proxy statement and a couple of earnings report. So overall, this is what the company's business is, what they do, what their moat is. Now let's talk about, there is a question, why are they down 30%? So when I listened into the earnings call, and after that I bought the shares because they were down 30% for two reasons. The revenue was down, less than what the state was expecting, and the margins were also lower than the state was expecting. Now, why the revenue was down? There are the biggest reason why the revenue was down is overall in the US, organ transplant was down in this quarter because of summer, like summer travels and holidays, etc. So, patients are postponed some of their operations. And TransMedics being the largest player, they have a 70% market share, got impacted. So the CEO had mentioned multiple times in the call that it is not due to the competitive pressure. It's not that someone else has taken up the shares from us. It's just that the overall market is down. And we being the biggest player, that's market risk is always going to be there. If the market itself has gone down, we will be impacted, right? But so are all other players. Now, number two is around margin. So this is the first year of them buying an airplane company. They say we are still learning. We had some unplanned maintenance in our aircrafts, right? So, and because we had an unplanned maintenance in our aircrafts, we couldn't use our planes, but you still have the cost, but you couldn't derive revenue out of it. So your margins get impacted. Number two, we actually now had to go out to third-party airliners and use them to transport the organs. Because you can't, organs can't wait. You still have to deliver the organs to the destinations, whether it's your aircraft or your, others' aircraft. So they say we had to pay more over that. Again, we'll have to look through and say, how the other companies did. Unfortunately, I couldn't find any other companies which are public. So we don't have that information, but these are the reasons given by them. And they have not yet changed their outlook or not reduced the outlook for the full year, because we're going to catch up. These are the short-term tailwinds that we had for this one. So we still maintain our full year outlook, whatever they have provided. Okay. So that's the reason why the stock was down 30%, is because they had a pressure on the both the revenue as well as on the margin. So thing to keep an eye on is this: if this unplanned aircraft maintenance stuff, right? Is it only one time? Right? If you see this occurring again and again, then we still have to start doubting it. Guys, maybe you should have had just the um, should have never bought an airline. You should have just always used the third party. We'll see. Number two is organ transplant. Overall number of procedures for organ transplant down in this quarter due to summer travel and holidays. I don't know. I mean, I might postpone my travel plan than getting the procedure which is important for me personally. I don't know how the others will do. So we'll have to look into how many organ transplants were done in this quarter to verify this. This is straight away coming from whatever the management had to say in an earnings call. And for now, that's the only information that I have, right? So you can make your own judgment call on what this, but these are the two reasons why the stock is down 30%. Yeah. So I did a keep on radar position, so which means a very small position, so that when I open my brokerage platform, I see that TMDX is there. I'll follow the news on it. I'll see what else is happening in this, and then see if I want to build a position on it or I want to dump it. Right? So don't go and just buy it now. Hey, it's a new account in a portfolio. This is just a keep on radar position. Okay. And as I learn more about it, I'll come and share with you. All right, let's look at some questions. Okay, their system can prolong storage. I think we talked about why are they down 30%. We discussed what is their TAM. Graph shows 16,000 transplant per year, seems limited. I think it's yes, 16,000 is the donors, which so they are doing 16,000 are total number of total donors. Now let's look at, I haven't looked at the financials yet. So let's maybe quickly look at what their revenue was. Yeah, we'll get to know how big, and man, annually they've been growing like gangbusters. Oh, it's been around in public market for much longer than what I thought it would be. They've been public since, or at least we are financial since 2017. It'll be good to, once I run it through the financials scoring sheet, probably good. But looks like over the last 3 years, they've been growing their. So I think this is what, when you grow your revenue more than 100% year over year for 3 years, you kind of tend to set the expectations of the Wall Street, right? And now if you're not grown, and let's look at a quarterly one. Well, they grew only 64%, which is what the market didn't like, because they've been growing more than 150% quarter over quarter for many quarters for past, whatever, since when? This was the COVID, so no operations happening. If we ignore that, yeah, since 2020, they've been growing like more than 100% every quarter. So I guess that's also plays some part into it. Let me just look at, I don't expect them to make any income yet. Yeah, so very small operating income, that is fine. Other thing I don't like it is they're still, diluting shareholders. which is almost 9% additional shares. Something in a long term, I won't like it. I want my companies to have less than 4%, very small operating margin, because right now they're investing everything. Yeah, we can't even talk about free cash flow. But yeah, I think it's right now it's a revenue story, and they have been growing. And even in this quarter, they grew only 64%, and I think that's what the market has punished it. She said it's a lame excuse. Some of those who need transfer not going to wait. Yeah, I wouldn't wait if I was me. Right. Sylvia has the same one. But I don't know. We'll have to go back and look at the number of procedures done previous quarter versus this quarter, or this quarter last year versus Q3 of this year. I don't see a reason why a CEO would kind of lie, because this number, those who are analysts, they can check this number, right? But yeah, I won't wait. What channels do you use to watch a ticker? I mean, I became active on Twitter year and a half ago, to see what companies folks are watching, etc. I also listen to many podcasts. Ping me on Meetup or email me. I'll send you the link to an episode, or to the session where I discuss in details all the podcasts which I listen to, and what I derive from each one of why I listen to each one of the podcasts, right? Some of them are around stocks, some of them are around options, some of them are around a macro side, some are for crypto, some are for general investing. So all this combination is where I source my ideas from. Right? There are websites like Motley Fool is there. What others? Yeah, sometimes Seeking Alpha. Yeah, so there are many. But what I don't do is to put my money based on what an analyst has to say. I'll use that information to build my own analysis and make myself comfortable. And if I'm not comfortable, yeah, others are, that's fine. Stock is not for me. Like I said, I'm not comfortable in understanding the whole medical side, so I'd never invested in some of these, let's say Eli Lilly, etc., or not Eli, but at least the Cignas, the healthcare insurance. I mean, healthcare is like second. It's supposed to be next year second best earnings growth story. I don't understand that. Yeah, not for me. You need to know where your circle of competence is. How to make off-market trades? At least on Thinkorswim, you can select, says extended market. I think Robinhood allows you to do that. On Thinkorswim, you can say send a, it's the validity of the trade, it extended EXT trade, or let me just share how does it show up. So if you, instead of a day, okay, hold on, stock, instead of a day, you can select EXT, which is extended time. So which is after the market hours. So nowadays, what NYSE is has decided to extend the extended hours. So now you can trade on Arca exchange for what, 22 hours a day. I don't know, I would want to do that, but just in case, this was the news maybe last week. So that's TransMedics. I still have to run it through a scoring sheet. But this is like my initial analysis on to have a radar position, right? Nothing more than that. It's just a radar position for now. All right. What's an example of a health tech company? I mean, this is in a health tech sector, medical tech sector. TransMedics is there. What else? I guess Illumina could be another one. Da Vinci one, ISRG, Intuitive Surgical. There are many medical tech companies. NanoX, right? That's a moonshot. So there are many medical tech companies. All right, so Let's talk about other stuff. Private markets boom. And I get pinged on LinkedIn and sometimes also on Twitter around a lot of asset managers trying to, basically provide me options for how I can get access to some of these very, some of the markets which are private credit or private equity markets, or how can I get early into areas which are reserved only for high, institutional investors, right? Over the last 1 year, I'm seeing, a lot of things around that. And then over the last 2, 3 months, I'm seeing that a lot of these private equity or private, um the purveyors of a private wealth or credit, call whatever you may, are now all focused on retail investors. Right? So there was a news in Wall Street, Apollo, State Street, they team up to launch a private credit ETF, which is like, it's a kind of an oxymoron. One of the biggest challenge in the private credit, and why I've not invested in, is even if there are two biggest challenges. Number one is the reputation, right? You don't have much information about the company. Number two is these investments are generally illiquid. They're tied up for a period of time. An example of a private credit would be, my friend is a real estate developer, he needs money. Banks may not be willing to lend him money because maybe he's not in this business for long. I know he's a good friend. I can lend money to him. That's one example of private credit. As a private individual, I'm extending a credit to a developer who needs it, and maybe he'll pay me 10%. Right? Banks are charging 7. He'll have to pay something more than what the banks pay to get access to the credit. But then these investments are not as liquid, right? That money will be tied up until they build the house and they sell the house. Bigger counterparty risk is, what if my friend goes bankrupt? So I'm like, private credit, adding ETF. ETFs are supposed to be very liquid. How are you going to do that? Right. So now we are seeing, there was one user on Apollo Street. Apollo is a big private equity player. Apollo, KKR, all these things, right? So, and they tied up with one of the biggest ETF issuers, which is like State Street. Marriage of these two will produce a private credit ETF, which we as a retail investor can go and buy as if we buy any ETF. So that's their pitch. And nowadays, a lot of talk has been happening around why retail investors should get into alternative investments. But these are all part of alternatives. The bigger theme is around alternatives, which are like private venture funds. I mean, I have seen company, and I think I talked about some of them. The companies that were real estate funds have now become AI venture funds and now are inviting capital from retail investors. Like, why? Why would you do that? And it sounds very sexy, sounds great that I can get into non-public, I can get into private companies, become an early investor. But right, many of the private companies just don't even see the face of public, right? So anyway, looks like everyone is out to think about retail investors, want to give more and more opportunity to them. So let's dig a little deeper into what the heck is happening here. There was a big article on how the private credit is going mainstream. Apollo, we already talked about. BlackRock, KKR, they all looking to launch one or other type of private credit instruments for retail investors. Now, if you look at the overall returns, 2017 to 2013, 8.1%. 2020 to 2023, 10.4%. 2023 to 2029, 12%. I mean, why would I invest in it? These are not very attractive for the amount of the risk and the illiquidity that I may have to take. Okay, it's a ETF, so probably you can take out the illiquidity risk out, but you still have a counterparty risk. Right? So now why they are like coming to, bringing it for mom and pop? Let's address some question. Who are the players? Players we already said. Why now they're coming to retail investors? Because the institutional investors, the sophisticated investors, the endowment funds, they've already reached their allocation. They will have a diversity. I mean, each of these big funds, they say, I'm going to invest 10% of my portfolio in alternatives. Right? 5% maybe in venture funding. So I will find out the GPs and invest in their funds. 60% will be in public companies, 30% in REITs, whatever. The sophisticated investor, they've already reached their allocation of how much they want to allocate to private credits, right? Now, what happens to these Blackstone, these Blackstone, BlackRocks? Where else they go if they have to raise money? Now they're looking for retail investors. We're trying to rope them in because they have to make money. Right? Can it beat S&P? Doesn't look to be. I mean, and again, for us, it is another way to invest. For me, it's not that attractive yet. Is there a liquidity risk? There is a liquidity risk because the profile of the private credit, in which the money get tied for a longer term, whereas the ETF, you should be able to trade in and out multiple times a day. So what these firms are trying to do is have a third party, in this case, let's say Apollo, be provided the liquidity. Means if you want to sell, Apollo will buy. Right? But what if Apollo runs into trouble? Then you're holding the bag, because there is no other liquidity, because it's a private credit. There is no liquidity behind coming directly from the businesses in which it is investing in. The liquidity is artificially provided by the issuer, which is kind of a backstopping it. So be aware of that stuff. Okay. Fund managers historically have sold these high fee product to big institutions, insurance and pensions. So it's not going to be cheap. Right? So be aware of the fee, be aware of the third party risk. Apollo is a big company, may not go bankrupt. So was Lehman. So was Bear Stearns, some point of a time, right? What else? Other thing, a federal appeals court struck down the efforts by SEC to make private fund managers disclose the investment and fee calculations more fully. So you won't even know how the fee is coming from, where they're investing in. Kind of have a faith in BlackRock or Blackstone and assume whatever they're doing is fine, right? That's entirely up to you. So yeah, so fee, liquidity risk, fee, counterparty risk, and then there are, I think I'll skip. So there are different flavors that these issuers are creating. Oh, you don't like this? How about this? Or not this? How about this? So as a retail investors, I'm seeing a lot of time we are being bombarded by these esoteric instruments trying to attract us and say, you now have access to the stuff that you never had earlier, only big institutional investors had. How about that? Sounds great. Make sure it's good for your risk profile. Make sure you understand what you're getting into. Right? I don't think these Wall Street firms are looking out for you. They're all looking out for themselves. They have to make money. Number two is, I think I have a, yeah, this is another one I saw. And I tweeted about it. I'm like, what the heck is happening here? BlackRock and Nuveen, they tied up together to create another one, ETF, so that the ETF then they can sell it to retail investors based on collateralized loan obligations. And I'm like, I can't understand this. This is how it works. The issuers, they buy the junk rated bonds from corporates, right? So if I'm a BlackRock or Nuveen, and those issuers, they they raise loans by sorry, they raise money by floating the debt security. Let's say if I want to buy a corporate bond, I want to buy junk bonds, means high yielding bonds from corporates. I need money. I don't have money right now. What I'm gonna do? I'm gonna raise money from the market by issuing my own debt. Right now, multiple tranches of these debt are combined into a CLO and will be sold under a ETF wrapper to the retail investors. So what am I buying? If you are a retail investor, what are you buying? You're not buying the corporate loans, but you're buying the floating debt securities that I have offered. You're not buying the loans that uh, the corporate loans from these junk bonds, but the one which I have raised. And these CLOs get triple rated by rating agencies. So my question was, the debt that is secured by junk rated bonds, how can that suddenly become triple rated? So I've raised a debt to buy the junk bonds. So junk bonds by definition are junk bonds. They are not triple A rated. And I've raised debt to buy those bonds, but the debt is not triple A rated. What if the bonds don't perform? How do I pay off those debt? How do I pay the interest on that? There's a lot more risk on that debt now. I don't understand it. Maybe I'm wrong in understanding it. So if you are interested in these instruments, do a little due diligence. And if you smell something fishy, if you're something which is not clear, guys, public market is still a good place. Despite all the VCs and these firms which are saying public markets, not much, we should need to focus on alternatives and all that. I think public market for retail investors is still a good market to invest in. Even though the number of issuers have come down, the number of stocks have come down, still there are great companies out there. Don't get into these instruments unless you understand each risk of these instruments. Okay. Goldman coming up with an ABS, right? To slice and dice the loans into bonds and then, pull it to retail investors. Why so much of a love for retail investors? What are their motives? Last 3 years, nothing much is happening in capital market. No IPOs, very few IPOs. Merger and acquisition is almost dead because Lina Khan won't let she won't even let Amazon buy a Roomba company. She won't even let two luxury bag companies, right? Tapestry and which was the other one? For Capri, merge. So merger and acquisition is dead. So how does the PE firms make money? They buy companies, then they sell it. They can't now sell it to another one because the acquisitions are dead. And the PE firms have to return capital to their investors. How do they return it? If you can't IPO the companies that you bought, you can't sell the companies to another one because mergers are dead. You have to find another source. Let's get that source as a retail investors. Let them become a exit liquidity. Maybe I'm a very skeptical in my thinking, but I have to look out for myself. You have to look out for yourself. There's an interesting article I read on Financial Times, right? There are already worries around this whole leverage that PE firms are using because to return the capital to their investors, they were levering up. You can only lever to a certain extent, right? Beyond that, you have to find other source of revenue. And this is actually came from a PGIM is a very big, I think one number two is a PE firm. And I found one very honest comment. The tide we have all been riding for the last decade and a half is out. Only you guys are supposed to be the best in the business, and all you were riding was zero interest rate. That's all. Once the interest rates start to increase, the best brains in investing are feeling the same pressure like you and I. Come on, guys, you should do better. So anyway, I'm not surprised Why suddenly all these esoteric funds are trying to target retail investors? Because the other sources of income have started to dry up. And if you can return a capital, let's say if your institutional investors, endowment fund have invested in you 5 years ago or 10 years ago, generally it takes 6, 7 years for you to, clean the company, make it ready for IPO or for acquisitions. And now that's not happening. What face you will have to go to your investors when the tide has turned, say, hey, give me more money. So you have to figure out a ways how you can return the money to your investors. Okay. So yeah, I won't be investing in these ETFs. You can decide on based on your risk profile and how much you understand it. Thought I'll share because I see a lot of these coming up in the markets nowadays. A lot more talk around why alternatives should be 10% of your portfolio. Right? I look at other alternatives in which I can freely trade in. I don't have a counterparty risk, something that I understand really well, right? Not the CLOs and not these tranches, etc. Sridhar says Leena Khan is doing few good things, making subscription easier to cancel. Yeah, but that's not a Leena Khan. Easier subscription, easier to cancel. Isn't that CFPB? But in any case, I mean that's a whichever government agency is that's good. So that's a roundup. Lot of stuff that I'm seeing on the private market side. Maybe another 10-15 minutes for quick earnings. Otherwise, you tell me, want to go through earnings or we just hit our 2 hour mark? Generally, I can stay for 2 or 30 minutes. So we still have some time, but I want to make sure it's useful for you. Should we look at some earnings or maybe address the general questions? Earnings. FSLR. I've never had any position in FSLR and not looked at FSLR. Give you a quick. Isn't FSLR is a little bit politically impacted trade? If Donald Trump coming in, all these green energy trades companies might get impacted. So let's okay, forget. So that's one thing that you need to be aware of. What else on FSLR? Let me just see. Negative free cash flows, no free cash flows. How old is this company? Been in public market for at least some time, almost 10 years. Revenue has been growing at pretty patchy. Uh, no free cash flow. 46% gross margin, 34% net profit margin is. Yeah, this is pretty seasonal, right? 1 year there is no consistency. Pretty volatile business. And the solar market, I mean, depending on what China can do, uh, this stuff can stay under pressure because they can produce all these solar panels at very, very cheapest. And what's the mode that they have? I don't think they have any mode. Yeah, so I'm not really interested in this one. I I mean it's not the best business. It's not a great business. The stock price might go up and down based on what the political scenario is, but I don't think it's a great business that can compound over a long term and have a much better return on what's their ROIC? Yeah, single digits. Many better opportunities outside. Enphase is cheaper than FSLR. I think Enphase I looked at, but I've never had a position in any of these. Atul says solar is under current admin has not done well. Material cost HOA lobbying made revenue earnings difficult. It shows up. I mean, the the business doesn't generate enough return on the capital that you give it. So I'm not interested. Again, the other thing is you always have to look for, of course, keep your diversification in mind. Is there are better opportunities, right? I think I can probably have a better opportunities than FSNR for my capital. Let's look at some earnings. So quick, let's start with Uber. Revenue of 20%, gross profit of 20%, operating income, net income of 1000%, right? I'll tell you why it is. Yeah, just just don't jump in joy if you're an Uber shareholder that your net income is up 1000%. They beat on both revenue as well as EPS, right? Revenue of 20%, but the growth is slowing down. If you'll go back and look at 3-year CAGR, that's up 32%. Right? So it's still growing, but at a slower pace than it was growing earlier. Right? Don't be fooled with 1000% increase in net income. Most of it is coming from accounting stuff, which is you have to basically, if you have equity investments, you have to take unrealized gains on your P&L. So it's not even a useful metric to track for Uber, so ignore it. First time the operating income is more than $1 billion. That's a milestone that company had achieved. And they have a $2 billion of free cash flow, which I think they can use it for various purposes. Now, the company can generate some free cash flow. It gives them a lot of flexibility on what they can do. You can reinvest in the business, great. You can acquire some company. You can return the capital to shareholder. You have optionalities, right? And if the market goes, let's say the market goes bad, you can buy some cheap companies, only if you have that cash. Look at the business metrics. Some of the things that I want to track is gross bookings, right, which give us an idea of, the overall number of people who are booking it. That's up 16%. It's a good number, but not great, because it's still lower than what it historically has been, right? What else? So the number for current quarter is fine, but the growth rate has come down, both the trips and the gross bookings. Maybe, yeah, this will be more visible here. If we look at the trips, 3-year CAGR was 20%. This year it grew 17%. Gross bookings, 3-year CAGR was 22%. This year grew only 17%. If you look at the last one, trips growth year over year, the second last row, 17%. This has been the slowest growth since I actually started tracking these numbers since Q3 2022. Same is the case with the gross bookings. So while the current quarter numbers 16%, etc., fine, but guys, your growth is slowing down. Guidance they gave, bookings of whatever, basically 16 to 20%, which is again slower than usual. So market is like, looks like your growth is now started to moderate. You're not gonna grow as much as what you've grown previously, which is okay. As you grow bigger, if your base is start to become bigger and bigger, the growth rate will become smaller and smaller, right? Thing that I want to focus on also on the capital allocation. They did a $375 million of a share repurchase. I like the new CFO. I actually tweeted about it because when I was going through its earnings report, I mean, I've not seen many of the executives actually publicly and commenting on giving us idea of how they want to allocate capital, right? So a few things which I like from their earnings is on capital returns, we steadily plan to increase our share repo in the coming quarters. So they did what, 350 million, 375 million, 375. So they're gonna increase it again, which is for me as a shareholder, is good. We're looking to do a significant durable share count reduction in 2025. Right? As a shareholder, I have a bigger slice of your business then, right? Now quickly to touch on M&A. We remain extraordinarily disciplined, and I want to emphasize that all opportunities are reviewed with a rigorous value creation mindset, and Uber bars for M&A has never been higher. I hope this is not a lip service. There are many CEO and the CFOs who will go and do a merger and acquisition just because they want to expand their area of influence. Feels my personal worth, it becomes bigger if I am a CEO of a $10 billion company instead of a $5 billion company. Is that good for shareholders? Is that shareholder value accretive? Who knows? Who cares? But at least running through this, or at least giving at least a lip service, I find it very refreshing. Just as a reminder to everyone, as I said at the start of a call, number one priority is organic investments aligned with a growth strategy focused on what's going to drive free cash flow. Maybe I should run a search for how many CFOs talk about free cash flow or return on invested capital. All CFOs and CEOs talk about revenue growth. How we are going to grow our revenue. But all revenue growth is not good for shareholders. They are not value accretive for shareholders. All earnings per share is not value accretive for shareholders. Right? But for whatever reason, Wall Street focus on revenue and EPS. But you can manipulate the EPS very easily. But you can't manipulate your free cash flow. So I really would love the management if they focus on increasing your free cash flow. I think he's a new guy, Prashant. I don't think I've heard him before. I mean, over last 2-3 quarters. But I like this refreshing concept of around focusing on being very disciplined in terms of M&A, focusing on reducing the share count and driving the free cash flow. Okay. So stock was down 11%, but I'm not bothered about it. It was down because of the weak forecast for bookings. So that's fine. This is why the EPS or the net income was up 1,000%. It is because of the $1.8 billion came from the others, something unrelated to their business. They had an unrealized gain on all these investments. Okay. What else I saw in the earnings call? We talked about it. Freight is still challenging because I saw that they were not growing that much. They haven't yet cracked the code. I think that's what. So my take, I'll still hold the shares that I own and maybe sell a bullish triangles, right? So far, I've been selling neutral triangles, but maybe I'll tilt a little bit bullish, continuously reduce the cost basis. But I think I'm still bullish on this one. I'll hold it. And there were talks around if it's going to buy Expedia or not. Oh, this wasn't discussed in the earnings call, so I'll skip that one. So that's on Uber. Questions? Any questions on Uber? Attention, say lithium mining was approved recently, but that may be on watch list. Lithium, I think lithium, maybe in once or twice I have traded in lithium using an ETF. Was it LIT? But it had a pretty bad, not now, maybe it was something else. Yeah, I think this is what I've used as my instrument earlier. Yeah. But I'm not a big on commodities. Only commodities that I trade in is GLD and SLV, gold and silver. So, but if individual lithium mining company, maybe I'll look into it if I know in individual company. Again, that's not my area of competence. So I'd rather go with the ETF. Crazy how Uber hasn't really turned a profit. Heard they're waiting on. Yeah, it's a low margin business. That is true. It's a low margin business, but it passed my snap test, which is like if I snap a finger and make Uber vanish out of existence, Uber disappears. Will we miss it? I think I'll miss it. So I'm still on Uber. I'm not invested in Lyft because Uber has a lot of optionalities which Lyft doesn't. So that's Uber. All right. Let's talk about the next one, the Meta. Everything up. There's nothing to worry about on Meta. Revenue was up like 19%, profit up 19%, operating income is up 26%, which is what I like. So that's a little bit of an operating leverage. When your operating income grows larger, more than your revenue, your operating leverage start to kick in. Net income is up 35%, kind of ignore it. I rather focus on operating cash flow up 21%. Right? So both beat on revenue as well as on EPS. Overall, great performance across all the financial metrics. Let's look into how the business metrics are doing, right? Advertising revenue up 19%, family of apps 19%, reality labs minor, so let's ignore that. What we want to focus on, how much is the reality labs losses? What, another 4 billion losses, right? And AR, average revenue per person. Oops, not billion, it's $12.29, which is up 12%. Other big thing I want to focus on, how many people they have, family of daily active people. 3.3 billion people, almost 3.3 billion people on their platform. We have what, 7 billion people on earth? They got a half of world population on one of their platforms. They can sell a lot to these people, a lot more than what they have. So 3.29 daily active people, and still it increased like 5.5% year over year. So I think last quarter when I talked about it, I'm like, it's got 3 point whatever 1 billion or something. And how much can it grow? It continues to grow. And at some point of a time, this growth will stop. You will run out of more people on planet, right? With the smartphones or with access to internet. So you have to look at other ways in which you can monetize the existing customer base that you have. That is why I was focused on what's your average revenue per person. Are you increasing that, right? And which in this case they are. So what else I want to focus on? That's fine. Let's quick look at the comparison quarter to quarter. Even year to year, 3 year, everything looks fine. Right? Capital allocation, they did a share repurchase, so almost $10 billion plus of overall capital return to shareholders. Guidance, $45 to $48 billion. Full year expense, $96 to $98 billion. So this has been updated from prior range. Reality lab expenses to increase meaningfully year over year. CapEx, they have increased their lower range. This was 95. So net, new year, 2025, significant capital expenditure growth in 2025. And they're going to make headcount investments in 2025 more than what they made in 2024. So increasing capital expenditure, increasing headcount, and they're going to have a more pressure on margins because of the depreciation that will all kick in, accounting, because of accounting. So margins will be pressurized in 2025. Straight didn't like it, saying there's a huge capital expense. When we're going to see the profits, stock was down 3%. Oh, after market. And I think I'm not bothered about it. They still have, like I said, half of a world population on it. Market didn't like the increase that basically they increase the lower limit of expenses. If you look under the capex, they moved it from 37 to 40 billion to 38 to 40, and 95 to 99 they moved to 96 to 98. So market say, oh, you're spending more than what it told us earlier, and you're telling me that in 2025 we'll continue to spend more. What's the value, right? So everyone is wondering how the dollar will result in value. I mean, that's a case for all AI investments, right? the question that all these big overall, and this is the last one, I'll probably not, then we'll across all the max, I mean, these big hyperscalers, right? $200 billion of capex has been committed on AI. If you add up what Microsoft, Google, Amazon, Meta, Apple, they have done $200 billion. The question is, if you're spending $200 billion, how much of you are gonna, generate out of that? No one knows today. But no one wants to be in a position where there is, gosh, I'm left behind because I didn't have enough GPUs and my competitors have now taken over the field. So that's why we're seeing so much of a capex going on. I think, who did I hear? I forgot who I was listening to. But what that person was saying is, if I think God doesn't exist, and if God do, I'm in a huge trouble. I don't want to be in that situation. Similar to this, I don't think that AI is gonna materially change the way world works, and there's not much of a business value to be derived of it. And if I turn out to be wrong, kind of a dead. And no one wants to be in that position, right? So everyone is spending. All hyperscalers are spending $200 billion. Right? When it comes to Meta, the stock is expensive. If you look at a peg, but it's not too much, man. PE is 27. I think S&P PE is, I don't know what the latest one is, maybe 24, 25. Not hugely expensive, even from a free cash flow perspective. So I don't think I'm gonna sell my shares. I'll still hold it. I'll probably sell an iron condor against my existing position, trade around it. If it goes down, probably I'll buy a few more at a cheaper price. If it gets egregiously, if it goes too high and the valuation become egregious, I'll be okay to sell some of it. Right. So that's my thought on Meta. All right. Yeah, if we have still done, maybe we'll cover some next week. But I guess another 5 minutes. We can talk about anything else. I'll sip some water. And then we'll call it a day. Couple of comments. Amazon, Google have been buying nuclear power plants to source energy for AI. Of course. But 3 Mile Island is what Microsoft did. Then Google did some SMRs, or was it Amazon did SMRs? And yeah, everyone is trying to make sure that they have enough power availability of power, because these AI chips will need power. Right? NVIDIA is going to replace Intel in the Dow index. Is that the top of NVIDIA, Rajiv? Intel was inducted into Dow at the height of .com. Again, I'm not saying anything, guys. But yeah, and more interesting would be to see what happened to SMCI, because they got inducted into S&P 500 very recently. And now with all this accounting and fraud and the stock price crash, will they be thrown out of S&P 500 again? We'll see. But yeah, Intel, the famed, it's to be a dream job to work in Intel for, if you're an engineer, electrical engineer, man, that company lost its way. Well, we'll see how it comes back. Intel actually reported results. I did not have a time to go through it. I mean, again, it's not a huge part of my position, so I'll go based on the bigger portfolio positions first, and Intel didn't make the cut yet. But I think the stock had done, stock was up like 10-12% after the earnings. I don't know what they did in earnings. But that doesn't mean anything, because even after that bump up, probably Intel is still down 51% for the year. Wow. And yeah, 51% still for the year. So what is the expectation for Melly earnings? I don't know. Let's look at what the street is expecting on Melly. So let's go to let's see. Let's go to Yahoo Finance and see what the street is expecting. Let's do belly and see. So, what is street expecting? 10.59 EPS and your revenue to be 5.27 billion. That's what street is expecting. For Melly, what did they do last quarter? Melly, yeah, so 5. From 5.0 to 5.2. And if you go back and look at Q3 2023, 3.7. So now we're expecting 5.2. So that's a growth of what? 5.2 minus 3.7. That's almost 40% growth, which is in line with what Melee has been doing. It's so not too high in expectations because Melee has been doing close to 40% revenue growth since 2022 for almost 2 years. Prior to that, it was 60%, 90%, and all that. That's what. But again, I mean, there's a huge, still lot of a tailwind, even if they don't perform this quarter, because again, understand this majority of the revenue, almost all of the revenue from Latin America, so they're subject to currency fluctuations. So when you're analyzing Melly, we also have to look at constant currency, how they perform, because that's really tell them their operational prowess. I don't want to punish them just because of the currency fluctuations, because that's not in their control. But these revenue numbers, when converted into dollars, might give a different picture. So when results are reported, we'll see. I'll go through Melly results like I've done every quarter. That's the biggest position I have. What else? We talked about Uber. Cool. Looks like that's it for today. No more questions. Alrighty. I guess thank you very much. The recording of this will be up maybe by end of Saturday or latest by Monday, depending on, because nowadays it's like a little busy season. We as a family we got to go and meet many other families, so might be a little delayed, but maybe by Monday definitely it will be up on the website. So if you want to go back and review some of the stuff, you could do it on Monday. With that, let me show you where the location is. Where on the website I post the recording. So it will be under members and go to weekly webinars. This is where you'll see the recordings. Yeah, so I have a previous week up here. Other one section which I've not generally talked about is I do post the option trades. Again, you can only access it like 2 weeks older ones. The reason I don't do latest one, I don't want anyone to be guided / misguided, but you want to go through a thought process of why I'm doing certain things. You can say all it here. Okay, so nothing on, I didn't do anything on 18th, right? So Iron Condor on Insta Networks, what was my thesis behind it? I do put a note, right, behind each one of these. So if you're interested and you want to talk about it, why did I do this, or you did not understand the thesis behind it, the logic behind it, yeah, bring it up, right? This is Iron Condor on Meta, which I think now I closed it this week because it was profitable and what was my thesis worked out, so I closed it. So if you have questions, feel free to bring that in this meeting. Cool. Alrighty. Thank you, everyone. Good talking to you guys, and we'll talk again next week. Still a lot of earnings to come in, and I think I don't know, we'll not know by the end of next week, right? Who's in the White House? And I plan to go in person and vote. My mail ballot is here, but I want to go and vote in person. But we'll know. I guess we might get some idea. It's maybe we don't have to focus on earning. There will be other things to focus on. Who knows what happens in elections? Go and do your civic duty if you are allowed to vote. Uh, According to S&P, Harris will win. Yeah, who knows who will win. Do your civic duty, which I'm gonna do mine. So, Ramesh, you say you did it. No, I'll probably do it today. I want to do it in person. So thank you, everyone. We'll talk again next week. Bye bye. Alrighty.